Greetings, everybody. Welcome to Liberty Call. It is Tuesday, September 13th, 2022. Hope everybody's having a great day out there. My back is not. Been standing all day or laying flat on the ground, so not a lot of fun. But anyways, it's getting a little bit better. So not the best day in the markets, but like I've been saying for quite a while, this is something we could probably expect. And also with the volatility and the CPI numbers came out today. So we'll go ahead and cover all of those. Let's go ahead and jump in. Dow Jones was down just under 4%, lost 1276, closed at 31,104. The S&P 500 was down 4.33%, closed at 3932. NASDAQ down 5.16, probably the worst of the lot, down closing at 11,633. Small caps were down almost 4%. The VIX today was up 13.78%. Remember yesterday, I talked about how the VIX was up even though the markets were up. So maybe it was a little bit of a foreshadowing. And the VIX is currently sitting at 2719. All right. Other exchanges here in the Americas: Canada down 1.71, Brazil down 2.36, Mexico down 1.75. Moving across over to Europe, Germany down 1.59, UK down 1.17. See here, France down 1.39, the Euro Stoxx was down 1.65, Netherlands down 1.81. Spain was down 1.59, Italy down 1.36, Switzerland down only 0.9, and Portugal down 0.91. The Russian markets were split. The MOEX was down slightly at down 0.11, while the RTSI was up 0.27. Headed over to the Asian markets, Japan was up 0.25%. Australia up 0.65. New Zealand came in flat at down 0.01. Shanghai was almost or basically flat too, up 0.05. The SESE component up 0.39. China A50 up 0.87. The DJ Shanghai up 0.04, and the Hang Seng came in down 0.18, and the Taiwan weighted was up 0.59. So it looks like the Asian markets fared pretty good. I guess most of the contagion was probably the CPI number that came out earlier today. So is what it is, unfortunately. So let's go ahead and read through today's quick recap of the markets and see what they have to say. Stocks tumble after inflation report. Dow sheds 1,000 points. U.S. stocks sold off sharply after August inflation report came in higher than expected. The consumer price index for August showed inflation rose 0.1% from July, despite the drop in the price of gasoline. From last year, inflation is up 8.13%, while analysts had expected an 8.1 print. The sell-off hit stocks particularly hard, or tech stocks particularly hard, with Apple down 5, Microsoft down more than 4, while shares of Meta platforms dropped more than 8% today. Money markets forecast an 81% chance of a 0.75 percentage point increase in the interest rates when the Fed meets on the 20th and 21st next week, and nearly a 20% chance of a full 1% increase. So I think it's probably going to be the 1%, but anyone want to place a wager, let me know. We could put a quarter or dime on it and see how we turn out. This is the last inflation report before the Fed's policy meeting next week. Investors had hoped the Fed would have some reason to raise rates less dramatically, but the Fed is determined to quash inflation despite the risk of pushing the economy into recession, and Tuesday's report dampens hopes that inflation has already peaked. And here is the chart. Let me bring that a little larger. You can see, while it has started to trickle back down, it's certainly not super significant. I look at it as, this isn't the worst news, in the world. If we go over to the month-over-month chart, you can see we didn't have any increase last month and only 0.1% this month. It certainly is much better news than the previous months where we were having increases well over 1% or close to it. So while the market freaked out, I personally don't see this as necessarily the end of the world. So, all right. Some news about Social Security. Retirees could get their biggest Social Security raise in more than 40 years. Social Security recipients are up for a big raise next year. Benefits are projected to climb 8.17% in 2023, the biggest increase in more than 40 years. The projected adjustment, newly updated to reflect August CPI, will raise the average Social Security benefit of 1656 by $144.10, according to the Senior Citizens League, author of the projection. Social Security Administration will announce the actual COLA for 2023 in October. The increase is based on a calculation that compares the average consumer price index for the third quarter of 2022 with data from the same period last year. The index that used that calculation is the Consumer Price Index for urban wage earners and clerical workers, or CPI-W. That index rose 8.1% over the last year, while the CPI for all urban consumers, CPI-U, rose 8.3%. Although there is some negative news there, the COLA could push some high earners into the bracket where they have to pay income-adjusted Medicare premiums for 2022. Individuals whose 2020 income exceeded $91,000 and couples whose 2020 income exceeded $182,000 may have to pay more on their standard Part B premium of $170.10 a month per person. High earners also pay more for Part D drug plans. And there's some more fluff in there if you want to go through and read through the parts that I did skip over. All right. And government, you get a little bit of a break on one side, and then those in Washington want to go ahead and stick it to you again. So I didn't write this article or title it, so don't blame me that they put Democrats in the title. Why Democrats want to end lucrative retirement loophole. And this has to do with the backdoor Roth conversion. And essentially what that means is, for most people, they put money into a 401k during their working years. And, let's say, you save and the growth on that is, say, $1 million after 40 plus years of working. When you take that money out or take distributions or withdrawals from your 401k or traditional IRA, if you roll it over to a broker, if you take out $10,000, you just pay whatever your ordinary tax rate is based upon your other incomes and that withdrawal. And so if you're in, say, the 25% tax bracket, you would lose $2,500 off that $10,000 withdrawal. So what people would do is it's called a Roth conversion. You would convert the balance, or you would roll it into a Roth IRA and pay taxes on what the balance is right now. So let's say it's $1 million. So you would have to pay income tax on that $1 million today. So again, let's just use simple math, 25%. So your $250,000 goes to the IRS. And then that other $750,000 can get rolled into a Roth, which at that point, withdrawals from Roth IRAs, as long as the account is more than 5 years old, you would be able to take tax-free withdrawals in perpetuity. And there's no RMDs on Roth IRAs. So I think it was in 2008 or 9, during the last financial issue that we did have, you could spread that out over a couple of years. So if you owed $250,000 tax bill, you could spread that out over a 2 or 3 year period, so you weren't getting just crushed all at once. So anyways, let's go ahead and dive into this. Congressional Democrats want to slam shut a tax loophole known as a backdoor Roth IRA. One of the several proposed changes that target the retirement accounts of wealthy Americans. Democrats on the House Ways and Means Committee want to prohibit people who make more than $400,000 per year from converting pre-tax retirement savings accounts to a Roth IRA. The proposed reforms are a part of a Democratic push to raise taxes on the wealthiest to fund the $3.5 trillion spending plan. I don't think this is going to go over very well with the taxpayer. Under current law, individuals making more than $140,000 are barred from contributing to a Roth IRA. Again, that you have income limits. It's not like a traditional IRA where you can put in money regardless of how much you make, or a 401k. Where retirement savings can grow tax-free. However, since 2010, workers who exceeded the income threshold have been permitted to convert their pre-tax contributions into a Roth IRA. After paying income tax on the initial contributions and the gains, their retirement savings grow tax-free and will no longer be subjected to required minimum distributions. But the use of this strategy could be coming to an end. Democrats on the committee want to prohibit Roth conversions for people making more than $400,000 per year. If approved, the rule change would apply to distributions, transfers, and contributions made in the taxable years beginning after December 31st of 2021. So that's not great news. Also, they want to limit contributions to IRAs. Democrats also want to prohibit high-income taxpayers from amassing tax-deferred fortunes inside of retirement accounts. To do so, they plan to restrict people from specific income thresholds from continuing to contribute to Roth and traditional IRAs if they've already have 10 million saved in IRAs or other defined contribution retirement accounts. Excuse me. Under current law, taxpayers can contribute to IRAs regardless of how much they've already saved. The proposed limit on contributions, would apply to single or married taxpayers who file separately and make more than $400,000, married taxpayers filing jointly with taxable income greater than $450,000, and heads of households who make more than $425,000. So that's basically the gist of what they're wanting to do. Again, I don't think this is going to really go anywhere long term, but just to make you aware of what those in Washington are pushing for. They want to squeeze more blood out of the stone, but it is what it is. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. If you haven't already, please smash the subscribe and like buttons. I would greatly appreciate it. And hope to be back here tomorrow and see you then. Bye-bye.